This video is created by Jagrat Creation. It is on amalgamation of a partnership firm. I wish to solve one sum on amalgamation of partnership firm. Just observe the sum on the screen. This is the sum that I intend to solve here before you. P and Q are partners of P and company, sharing profits and losses in the ratio of 3:1. So P and Q are partners, sharing profits and losses in the ratio of 3:1. Q and R, partners of R and company, sharing profits and losses in the ratio of 2:1. So here PQ are the partners, here Q and R are the partners. So Q is a partner who is common in both the firm. He is a partner in P and company and Q is a partner in R and company. Wherein P, they decided to amalgamate the firm and form a new company, PQR company, wherein P, Q and R would be partners sharing profits and losses in the ratio of 3:2:1. So in P and company, P and Q are the partners, sharing profits and losses in the ratio of 3:1. Second company, wherein Q and R are the partners. Q is a common partner, sharing profits and losses in the ratio of 2:1. They want to amalgamate the partnership firm, and in the new profit sharing firm, in a new firm, in an amalgamated firm, the profit sharing ratio between P, Q and R will be in the ratio of 3:2:1. Here you are given the balance sheet of P and company and R and company. On the asset side, you are given fixed assets, building, plant, machinery, office equipment, current assets, stock in trade, debtors, bank balance, cash balance, due from R and company 1 lakh. And here, due to P and company 1 lakh. So there is a mutual indebtedness. Here, P and company has a right to recover money from R and company, and R and company is obliged to pay P and company. So this is mutual indebtedness. So when the amalgamation take place, this asset will be purchased, this amount receivable will be purchased, and this payable amount also will be purchased, and the receivable and payable will mutually be cancelled after amalgamation of the firm. So first, a new firm, PQR firm, will purchase the business of P and company and R and company, and after amalgamation, the mutual indebtedness will be cancelled. The amalgamated firm took over the business on the following terms. Building of P and Q was valued at 1 lakh, plant and machinery P and Q valued at 2,50,000, and R and company for rupees 2 lakhs. All stocks in trade were appreciated by 20%. Goodwill valued of P and company 1,20,000, R and company 60,000, but the same amount will not appear in the books of PQR and company. Partners of a new firm will bring necessary cash to pay other partners to adjust their capital accounts to the profit sharing ratio, taking the highest capital relative as the base. This is I'm going to explain to you while solving the sum what is the meaning of this highest capital relative base. Provision for bad debts has to be carried forward 10,000 in respect of debtors of P and company and 25,000 in respect of debtors of R and company. You are required to prepare the balance sheet of the new company and the capital accounts of the partners in the books of old firms. Now this is a sum on amalgamation of firm. So this sum can be solved by two different methods. One, revaluation of assets and liabilities method. And second, first firm and second firm are dissolved and the realization account is prepared. So the same sum can be solved one by dissolution accounting method and revaluation of assets and liabilities, and then transfer of the old firm to the new firm, amalgamated firm. So here there are two methods. So first of all, I'm going to solve this sum by which method? By revaluation method, wherein all the assets and liabilities before transfer will be revalued, and all those assets and liabilities that are revalued and revaluation profit will be transferred to the capital accounts of the partners, and the revalued business will be transferred to an amalgamated firm. So here I am going to prepare a revaluation method. So first of all, the number of steps that you are required to follow in revaluation method, that I am going to give you steps one by one precisely while solving the sum. And first of all, let me start with the preparation of revaluation account and partners capital account for P and company. Then I will prepare revaluation account and partners capital account for R and company. In light of revaluation, I am going to prepare the amended balance sheet, and the amended balance sheet will be absorbed after revaluation. It will be absorbed by a new firm after revaluation. So let me start with that. So here I prepare revaluation account and everything is to be prepared. But you are told that goodwill of P and company 1,20,000 and R and company 60,000, but the same will not appear in the books of PQ R and company. So let me prepare a working note for goodwill. So goodwill is adjusted to the capital accounts of the partners. So how the accounting of goodwill is to be made, let me make it clear. So let me start first of all with goodwill point. Then I am going to consider the revaluation adjustment. In light of that, I am going to prepare the revised capital account, and the balance sheet will be revised, and the revised balance sheet will be absorbed by the new firm. So goodwill of P and company. So P and company goodwill is 1,20,000. In P and company, the partners are P and Q. They share profits and losses in the ratio of 3:1. So goodwill will raised. So in this working note, I will raise the goodwill. So here P and company goodwill is raised and distributed amongst P and Q in the ratio of 3:1, their profit sharing ratio. So goodwill account debit to P's capital account to Q's capital account debit. 30 and 90 and 30, that is distribution of 1,20,000 in the ratio of 3:1. Same way, goodwill of R and company will be distributed between Q and R in the ratio of 2:1. So the profit sharing ratio between Q and R is 2:1. The profit sharing ratio between P and Q is 3:1. So goodwill is raised in the old profit sharing ratio. This is how goodwill is raised. Now goodwill is not to be shown in the balance sheet. So this goodwill will be written off in the new profit sharing ratio in a amalgamated firm. So 1,80,000 is to be written off. So when you write off 1,80,000, it is to be credited, and it is written off in the new profit sharing ratio, that is 3:2:1. So 90,000, 60,000, 30,000 is the goodwill written off in the new profit sharing ratio. Now let me work out the net effect of this. 90,000 credit, 90,000 debit. So no effect on the capital account of the P's capital account will have no effect. Goodwill account will be closed because goodwill is raised and written off. 1,80,000 is the raised value. Return of value 1,80,000. So goodwill balance will be nil. So goodwill will not appear in the balance sheet. Here 40 plus 30, 70 credit, 60 debit. So net effect 10,000 credit, and here 20 credit and 30,000 debit. So debit. So what is the net effect adjustment effect to the capital accounts of the partner? The adjustment effect will be R's capital account debit 10,000 to Q's capital account credit 10,000. This is how adjustment entry of goodwill to the capital account of the partners that we are required to pass in the books of the new firm. That is to be done after amalgamation. And no goodwill accounting will be made in the vendor firm. So P Limited, P company and R company will not go for any accounting of goodwill when they close their books of accounts, but this adjustment entry will appear in the firm after amalgamation. So what's the entry for that? The entry to be recorded, R's capital account debit to Q's capital account credit. This is the entry will be recorded for adjustment of goodwill to the capital accounts of the partners. This entry will be recorded by the new firm after amalgamation of both the firms. So this is a goodwill explanation. So the goodwill is not going to be considered by these two partnership firms individually when they want to close their books of accounts. Now let me start with preparation of revaluation account. Partners, I start with P and company. So let me have a curtain on this other company. Now building of P company is valued at 1 lakh. Building is how much? 50,000. Before that, I write the capital balance of P and Q to their capital account. So first step, consider. So what is the first step? First of all, write down the capital balances. Then consider the revaluation adjustment. Because revaluation profit or loss is to be transferred to the partner's capital account. So this capital account is going to be changed. So first of all, write down the balance of capital account. Then step number 1, consider the revaluation adjustment. So building, book value 50,000, revaluation made 1 lakh, increase in the value of building credited to revaluation account. So revaluation account is credited with 50,000. So what's the entry? Building account debit to revaluation account credit. So the value of building in my balance sheet will become now 1 lakh. So I make this 1 lakh value with red color. Now, second adjustment, revaluation adjustment. Plant and machinery of P and company valued at 2,50,000. Book value 1,50,000. So what is the increase in value? Book value 1,50,000. Valuation made for amalgamation 2,50,000. Increase in the value of plant and machinery 1 lakh. Increase in the value of asset is again credited to revaluation account, and the revalued value of plant and machinery will appear in the balance sheet at 2,50,000. This is how adjustment of revaluation is being accounted for. Now, after these two adjustments, all stocks appreciated by 20%. So how much is the stock? Stock is 1,20,000. Appreciation 20%, 1,20,000 into 20%, 24,000. So new value of the stock is 1,44,000. Increase in value of stock is credited to revaluation account, and the new value of stock I write in my balance sheet 1,44,000. Now, stock goodwill is done. This is the capital adjustment. Provision for doubtful debt is to be considered. Now see. So, partners, provision for doubtful debt has to be carried forward 12,000 in respect of debtors of P and company. So bad debt reserve is required to be created for P and company. So debtors are 1,60,000. Bad debt reserve required 12,000. Increase in bad debt reserve, revaluation account is to be debited for 12,000 rupees. And this bad debt reserve I write in my balance sheet on the liability side because it's a reserve against the asset. So all revaluation adjustments are considered. So first step, write the balance of capital account. Second step means first, after writing this balance in capital account, first step is to consider the revaluation adjustment. Second step, consider the reserves. Now close this revaluation account. This is a profit. Transfer to the profit and loss account of the partners in the ratio of 3:1. So P and Q's capital account is to be credited. This is how all revaluation adjustments are considered. Profit or loss on revaluation is transferred to the capital account. Next step, consider the reserves. Transfer to reserves. Here reserve 0. I'm sorry. Here reserve is 50,000. So 50,000 reserve that is required to be distributed in the ratio of 3:1. So 37,500 and 12,500 is the distribution of reserve. So reserve has become nil. Third step, that's very important, goodwill adjustment. We have already considered that goodwill will be adjusted to the capital accounts of the partner in the books of new firm. So in this old firm, means transferor firm will not take care of goodwill when it intends to close its books of accounts. So no entry for goodwill is made in the old firm, but the adjustment entry in the new firm that I have already explained. Fourth step, assets not sold to the new firm. Here all these assets are given. Are you given any information that particular asset is not sold to the new firm? If the asset has not been sold to the new firm, it has to be distributed amongst partners in the ratio agreed, or it can be distributed in the profit sharing ratio, or it can be also be distributed in the capital ratio. For that, the agreement between the partner is the most important thing. Otherwise, you can distribute in a manner prescribed in the sum. But in this sum, there is no question of any asset that has not been sold to the new firm. So all assets and liabilities are sold in the new firm. So this step is not relevant. Now, next step, liabilities not sold to the new firm. If any of these liabilities are not sold to the new firm, those liabilities are required to be borne by the old partners. Either they may distribute in the old profit sharing ratio, or the liability may be distributed as agreed between the partners, or it may be distributed in the capital ratio. But in this sum, this point is not there. So I'm just prescribing you the steps. Now close these capital accounts. And the balance of capital account will be transferred to the balance sheet. Now in light of these changes, my balance sheet total also will change and it should agree. So my balance sheet total is 8,24,000. This is the balance sheet prepared for P Limited, which is absorbed by a new company, PQR Limited. So this is an amended balance sheet, revalued balance sheet, and that will be absorbed by new company, PQR Limited. Now if you want to write down the journal entries in the books of P Limited, what are the various journal entries that you are required to write? Suppose that if you are asked to write journal entries in the books of firm in case of P Limited. Now see, the journal entries will be in this line. Revaluation, building account debit, plant and machinery account debit, stock account debit to revaluation account credit 1,74,000 first journal entry. Revaluation account debit 12,000 to bad debt reserve account credit second journal entry. Distribution of this profit to the partners capital account, revaluation account debit 1,60,000 to Piece capital account to Q's capital account 1,21,500 and 40,500 is the third journal entry. Distribution of reserves, that is 37,500 and 12,500. So general reserve account debit to Piece capital account credit 37,500 to Q's capital account credit 12,500. Distribution of general reserve is the fourth entry. Remember, first entry this one, second entry 12,000, third entry distribution of revaluation profit, fourth entry transfer of reserves. Four entries are over. Now the fifth entry, transfer entry. All these assets are given to PQR Limited. So PQR Limited account debit to building account credit to plant and machinery account credit to office equipment account credit to stock and trade account credit to debtors account credit to bank account credit to cash account credit to due from R Limited account credit. All the assets are given to PQR Limited. So PQR Limited is the receiver, debit the receiver, all assets account will be credited. Now this liability side also will be transferred to PQR Limited. So wherein Piece capital account debit 3,99,000, Q's capital account debit 2,13,000, creditors account debit, bank overdraft account debit, bad debt reserve account debit to PQR Limited account credit. So all liabilities are transferred to the PQR Limited account credit. This is how all these balance sheet balances will be closed, and this is how transfer entry will be recorded in the books of P and company. So this is how I have explained you how the ledger accounts prepared in the books of P and company, how the journal entries are recorded in the books of P and company. Now I want to do the same thing for another company, that is R and company. So let me start with that. Now here I am going to prepare in the books of R and company revaluation account and capital account. First of all, I will write down the balance of capital account of Q and R. Then next step, consider the revaluation adjustment. Now revaluation adjustment, plant and machinery of R Limited valued at 2 lakhs. So 1,60,000 is the book value. Valuation agreed 2 lakhs, increase in value 40,000, credited to revaluation account. So plant and machinery account debit to revaluation account credit, and the new value of plant and machinery will appear in the balance sheet at rupees 2 lakhs. So 1,60,000 is replaced by 2 lakhs. Now next, stock in trade is to be appreciated by 20%. So stock 1,40,000. 1,40,000 into 20%, 28,000 is the increase. New value of stock is 1,68,000. 28,000 is credited to revaluation account. New value of stock will appear in the balance sheet at 1,68,000. So the journal entry for that is stock account debit to revaluation account credit. Now next, requirement for bad debt reserve. You are told that 26,000 is the required bad debt reserve. So revaluation account debit to bad debt reserve account credit. Debtors 2 lakh. This is the bad debt reserve. This is the valuation made for debtors. So bad debt reserve debited to revaluation account, and bad debt reserve I show that on the liability side of the balance sheet, bad debt reserve. Now in light of these changes, all revaluation adjustments are considered. So what is the first step? Write the capital balances. What is the second thing that you are required to do? Consider the revaluation adjustment. In light of that, change the values of the assets in my balance sheet and balance sheet. Now close this revaluation account. Find the profit or loss on revaluation to the capital accounts of the partners. So total of credit side minus total of debit side. This is to be distributed in the ratio of 2:1. So Q and R's capital account is credited with revaluation profit. So revaluation account debit to Q and R's capital account credit. So consider the revaluation adjustment. Point is over. Now reserves. Transfer reserves. Reserves are to be distributed in the ratio of 2:1. So 1,50,000. General reserve account debit to Q's capital account credit to R's capital account credit. So reserves are distributed. Now it has become nil. Now assets that has not been transferred. Goodwill adjustment, as you know that it is going to be recorded in the books of new firm. So no need to consider goodwill right now. Once again, assets not sold to the new firm are to be considered, must be distributed either to the partners or must be realized in any other form, either by way of either selling it for cash or taken by a partner and agreed value. So assets not sold to the new firm. The assets that has been not sold to the new firm, those assets are required to be disposed by the old firm. The partner takes it at an agreed value, or it may be distributed amongst partners in the agreed ratio or in the profit sharing ratio, or asset may be sold for cash. So in this point is not there. Liability is not taken by the new firm. They are required to be distributed or they are required to be settled by the partners in any way. If any such information is given to you in the sum, must be considered. Close capital accounts. Balance of capital account is to be transferred to the new firm. So these are the capital balances. Now this revised balance sheet, this is the value at which the balance sheet will be, assets and liabilities will be sold to the new firm, and for that entries can be recorded, transfer entries can be recorded. PQR Limited account debit to assets account credit, all liabilities account debit to PQR Limited account credit. This is how the entries could be recorded. So after completing all these things, now I want to write the absorption of these two partnership firms in the books of PQR Limited. So these are the two partnership firms. So here I have changed the total. 734,000 is the amended total. Now these two balance sheets or assets and liabilities of two partnership firm is purchased by a new partnership firm, PQR Limited. PQR. So wherein PQR are the partners. So how this to be recorded in the books of PQR Limited? Let me start that. So here, journal entries in the books of new partnership firm, absorption of P and company, building account debit what comes in, plant and machinery account debit 2,50,000, debit what comes in, office equipment account debit, stock and trade account debit what comes in, then comes debtors account debit, bank balance account debit, cash account debit, due from R and company account debit to all liabilities are credited. His capital account credit, Q's capital account credit, creditors account credit, overdraft account credit, bad debt reserve account credit. So debits and credits are recorded. The total of debits is 24,000. Total of credits are also 8,24,000. Being the above assets and liabilities taken from P and Q company. So this is the first absorption entry. Same way I want to write out the absorption entry. Building account debit, plant and machinery account debit, office equipment account debit, stock in trade account debit, debtors account debit, bank balance, bank account debit, cash account debit, to Q's capital, to R's capital, to creditors account credit, to due to P and company, which will be mutually adjusted by the reserve account credit. Being all the assets and liabilities of R Limited taken over. Now see. Here due from R, due to P, this is to be cancelled. So this credit will be debited. So due from P account debit to due from R account credit, this is mutual indebtedness is cancelled. So it is a mutual obligation. So first firm has a right against the another. Second firm had an obligation towards the first. So obligation and rights are adjusted by this entry. Now capital adjustment, very important. Partners of the new firm will bring necessary cash to pay other partners to adjust their capital according to the profit sharing ratio, taking highest capital relative as the base. But before doing all these things, remember, we are required to write the adjustment entry for goodwill. Goodwill is adjusted to the partner's capital account. That is to be considered first. After that, this capital adjustment will be taken care of. Let me prepare a working note. This is the capital of P. This is the capital of Q. This is the capital of Q, and this is the capital of R in new form. This is the total capital. Now, effect of goodwill adjustment. R's capital account debit, Q's capital account credit. So from R capital it is to be deducted, and to Q's capital it will be added. So 10,000 added and 10,000 deducted. So after goodwill adjustment, capital will be 3,99,000. Here 541 plus 10, 551. 164 minus 10, 1,54,000. This is a capital. Now highest capital relative. What is the meaning of highest capital relative? This is the capital of the partners after amalgamation so far. That profit sharing ratio, as you know, it is 3:2:1. 3:2:1. So capital relative per unit of profit. So for 3 rupees profit, 3,99,000 is the capital. So what is the capital per rupee per unit of profit? Here for 2 rupees, 5,51,000 is the capital. What is the capital per 1 rupee of profit? So 5,51,000 is the capital for 2 rupees profit, or 2 unit share in profit, and 1,54,000 is the capital for 1 unit share in profit. So I want to find out the relative capital. To find out the relative capital, 3,99,000 divided by 3, 1,33,000. 5,51,000 divided by 2. So this is the relative capital per 1 rupee of profit. This is the capital kept by Q. For 1 rupee, capital kept by R is 1,54,000. Now this is the relative capital. Highest relative capital is the base. So this is the capital. Highest capital relative is to be considered as the base standard. So 2,75,000 is the highest capital relative. That is taken as base. So everybody has to be, every partner has to keep capital in proportion to this base. So 2,75,500 is considered as a transfer, is a standard capital per unit of profit. So 2,75,500 is the norm, standard, established for maintaining the capital. So 2,75,000 into 3, that is the capital required to be maintained by P. So P is required to maintain for 3 units of profit, 2,75,500 into 3. This is the capital to be maintained by P. 2,75,000 into 2 is the capital required to be maintained by Q. And 2,75,000 into 1, capital required to be maintained by R. So this is the capital required. This is the actual capital. So required capital minus actual capital is the amount to be brought by the partner. So B minus A, 8,26,500 minus 3,99,000, the amount to be brought by P, 4,27,500. Here 5,51,000 and 5,15,000. He is not required to bring anything additional because his capital is considered as a norm, and 154 and 2,75,500 is the required capital. So 2,75,500 minus 1,54,000, 1,21,500 is the capital required to be brought. Cash is required to be brought by these two partners. So let me write down the entry for that. Bank account debit or cash account debit to P's capital to Q's capital account credit. This is how capital adjustment is made. Remember, before going for capital adjustment, give the effect of goodwill adjustment. That's an important point to be noticed. So this is how the journal entries are recorded. Now I want to prepare the balance sheet of the new firm after absorption. So here I prepare the balance sheet. I am going to make a total building. So on the asset side, total building, have a total of P and Q. So total building 1,60,000. Plant and machinery total 4,50,000. Then comes office equipment 26,000. Then comes stock in trade total 3,12,000. That is 144 plus 168. Then comes debtors. 160 plus 2, 3,60,000. Then comes bank balance. For cash balance, remember, this 20,000, 10,000, and this is cash 5,49,000. So total cash is the 20 plus 10 plus 549. This is the cash balance. Now, capital balance is already considered. Creditors, total 120 plus 116, liability side. Then comes bank overdraft. Bad debt reserve I write on the liability side instead of deducting from debtors. So this is how all these things are considered. This is a mutual cancellation that is also being done. Now capital balances are already there. So capital maintained by P as per this note, Q's capital and R's capital have a total of balance sheet. So this is how the balance sheet is prepared. So this cancellation was made by me to explain the concept of balance sheet. So let me mention all these journal entries once again before you so that you can understand it better, that in examination you should not go on cancellation as being teacher I do for you. In examination, your journal entries will appear in your notebook in this fashion. Look at it. So this is how journal entries should appear in your notebook. So I have tried to explain to this some on amalgamation of partnership firm. I feel that you follow all these things. Thanks to you.